types of foreign exchange exposure. We'll talk about translation methods in FASB 52, the methods for managing translation exposure, and how to calculate translation exposure and gains and losses from changes in foreign exchange. There are three general categories of foreign exposure. Translation exposure, which is an accounting exposure, and that's just, you can think of it as just paper gains and losses as accounts in the balance sheet have to be restated for new exchange rates. Now, translation exposures will often lead to actual cash flow exposures. In the short term, we call them transaction exposures. So if you, say, had to pay more to satisfy a euro liability because the euro appreciated, that would be an actual loss, and we'll call that a transaction exposure. It's a real cash flow gain or loss. And there's competitive exposure. Competitive exposure is a long-term exposure to a currency, longer than just payables and receivables. So here are some examples. Translation exposure. An example of translation exposure would be a foreign subsidiary of a US-based firm records a 10,000 yen receivable at an exchange rate of 0.008 per yen. That means that $80 book value of the receivable is sitting in the parent's financial statement on the balance sheet. But then the yen devalues to 0.007. The book value of that now goes to $7, a loss of $10. It may have to be reflected as a loss to the parent company. Now, it will affect cash flows if the payment is actually made. In other words, the receivable actually comes in and they sell the yen at 7 and not 8. So in that case, a translation exposure leads to a transaction exposure, but doesn't always have to. The exchange rate could go bounce back up to 8 before the actual payment. A transaction exposure is an actual cash flow loss. For example, a firm has a 1,000 par euro bond that expects or booked at $1.20, so it expected to pay $1,200 to pay off 1,000 euro. But just when they go to pay the bond off, when it matures, the euro is selling for $1.40. In that case, it'll cost them $1,400, and they have a real loss there, a cash flow loss. A competitive exposure is a long-term exposure to a currency. So, for example, you have a factory in China that produces your goods that sells them back to the U.S. In that case, you have more than just receivables and payables. You have the long-term viability of the firm affected by changes in the exchange rate. Now, if the yuan were to appreciate, your cost of doing business would increase in dollars for the yuan production. However, you may be able to raise your prices, and that depends on the competitive situation. So if your customers also are producing in China, you've all seen an increase in your costs. You may be able to raise your prices. However, maybe your competitor produces in India. In that case, what you need to focus on is not just the yuan-dollar exchange rate, but the rupee-yuan exchange rate. We'll cover these two topics later, transaction exposure and competitive exposure. When we talk about translation exposure, transaction exposure, we usually, or I will usually, net the positions. So for example, if a firm has 100 euro million accounts receivable and a 70 million euro accounts payable, both due in, say, a month, what we say is their net exposure is their long 30 million euro. In other words, they're a net receiver of 30 million euro. So their exposure then is not on 100, it's on 30, because 70 of the 100 will be offset with the payable. And this firm will be, we consider them long the euro in that they benefit from appreciation. So if the euro were to appreciate while they're holding it, and then the accounts come due, they'll get more dollars when they sell them. However, you can also be short. For example, if they had a 50 million euro receivable and a 70 million euro payable, they're a net payer of 20 million euro. So we say the firm has a natural balance sheet position of short the euro. Since they are a net payer of euros, they will lose if the euro appreciates, because it'll cost them more to buy the euros and pay off the vendor or whoever has the payable. So the next thing we're going to handle is under what circumstances do we have to recognize gains or losses in the balance sheet. So let's start with an example. So Zapata is an auto parts manufacturer. That's an affiliate or subsidiary of an American multinational firm. So these are the balance sheet items in pesos. And these are in millions, but I'm going to drop the millions just to avoid saying millions 100 times. So it has 1,000 pesos in cash, 50,000 pesos receivable, 32,000 inventory, net fixed assets of 111,000. So you can think of this as property, plant, and equipment for total assets of 194. Payables, long-term debt, total liabilities. There's their equity position, difference between assets and liabilities. And the exchange rate currently is 12 pesos per dollar. Now the question is, well, if this exchange rate were to go from 12 to say 13, which would be an appreciation of the dollar, depreciation of the peso, would the parent firm have to restate these accounts and possibly show a loss on the US dollar financials? Well, that depends on the translation method. Let's look at 4 possible translation methods. One method, the current rate method, says use the current exchange rate at the time of updating the financials, say quarterly, on all assets and liabilities. In other words, if you think about a net position, if your all assets minus all liabilities would be your net position in the currency. So I take my assets minus liabilities, assets, total liabilities, you can see my equity position is 135 million pesos. So what I'd say is this firm's their exposure to the peso, if using the current rate method, is 135,000 pesos. But some people will get upset with this method. They'll say, well, things like property, plant, and equipment under fixed assets and long-term debt, there's plenty of time for the exchange rate to go up and down and up and down. So why don't we just revalue the current accounts and leave the non-current accounts at the book value? So if they did that, if I take cash and receivables and inventory, subtract off accounts payable, you can see in the short term, there's only 36,000 pesos we're a net receiver of. So let's just say we have a long position in 36,000 as our exposure. The next method is the monetary, non-monetary method. And this logic behind this is let's look at accounts that simply reflect sums of foreign currency. So, for example, property, plant, equipment, or fixed assets are not. Inventory is not an amount of currency. But if you look at these other accounts, they all just reflect a sum of pesos: cash, receivables, payables, and debt. So if I just take cash, receivables, payables, and debt, in this case, if I revalue those accounts, I'd say I'm short the peso. I'm a net payer of pesos. I will gain if it devalues. It would be cheaper for me to buy pesos and satisfy those debts. And then a hybrid method is a temporal method. Temporal method takes the non-monetary method and adds inventory. And the idea is inventory is really held to be converted to cash shortly. So we'll just add inventory to that account. In that case, we're long 24,000 pesos using the temporal method. Now the question is, what method do U.S. multinationals need to use? Well, up until 1981, under FASB 8, the temporal method was used, revaluing all monetary accounts and inventory, with gains and losses going to the income statement. Since 1981, under adoption of FASB 52, it's a little more complicated. It basically allows firms to choose between temporal method and a current rate method. So for a multinational firm, what this FASB 52 requires is for every subsidiary, you must state what the functional currency is. So assuming the reporting currency for all multinational corporations, subsidiaries, are going to be US dollar, we need to then decide for each subsidiary, we'll say a Mexican subsidiary, whether the peso or the dollar is the functional currency, and for a Canadian subsidiary, whether it's the dollar or the Canadian dollar. And the accountants would fill out some forms, which involves looking at kind of the general operating cash flows of the subsidiary and determine what the functional currency is. If the parent, the U.S. multinational company, chooses the dollar, say our home currency, as the functional, that subsidiary will use the temporal method: monetary assets, liabilities, and inventory. All gains and losses go income statement, which is exactly like FASB 8. However, they now have a choice. If you choose the foreign currency, say the peso or the euro or the Canadian dollar, as the functional, you use the current rate method. All right, that's not the current non-current method. The current rate method says use the current exchange rate for all accounts. In other words, all assets and liabilities and equity are revalued. However, if you do that, all the adjustments go to the balance sheet, they bypass the income statement, and they are simply an adjustment to equity. Most firms choose this method. Even though there's going to be larger swings because you're valuing more accounts, they go to the balance sheet, bypassing the income statement. So here's a question for you. At the beginning of the year, what is Zapata's exposure if the dollar or the peso is the functional currency? So we said if the dollar is the functional currency, okay, if the dollar is the functional currency, we're going to use the temporal method. Temporal method is monetary assets and liabilities. Monetary assets, cash, receivables, payables, debt, inventory. So my exposure to the peso would be the sum of those accounts, which would be 24,000 pesos, using the temporal method. If the peso is the functional, we're going to use the current rate method. In other words, all equity gets revalued, all assets and liabilities. So my exposure under the peso would be, this would be in pesos, would be my equity, assets minus liability, of 135,000 pesos. Now, if they choose the dollar as the functional, and the exchange rate goes from 12 to 13, is there a gain or a loss? The first thing I would like to do is decide whether it's going to be a gain or a loss. I can see there's 2 positive values and 2 negative values. Since under the temporal method they are long the peso, and the exchange rate goes from 12 pesos per dollar to 13 pesos per dollar, that is appreciation of the dollar and devaluation of the peso, you know they're going to lose. So it's either going to be this value or this value. If I do the math, my gain or loss is going to be on my long position, is going to be my position, 24,000 pesos, times just the change in the exchange rate. Since that's dollar per peso, pesos will cancel out, and that'll give me a dollar loss of $154 million. Now, if the peso is the functional, we're going to use we're going to revalue all accounts because of the current rate method, and my gain or loss in this case is going to be 135,000 times the change in the exchange rate, and they would lose 865 million. However, using the peso as the functional, this is going to go straight to the balance sheet, not to the income statement. That's why the firms prefer this method. It doesn't affect earnings per share. This gain or loss, although smaller, will go to income statement and affect net profits and earnings per share. So next thing I want to talk about is, well, how can we quantify what we could lose on a particular position? So Zapata, using the temporal method, knows they're long 24,000 pesos. On the parent's financial statements, the parent's US dollar book value would be the current position account value in pesos times the initial exchange rate. So it would be carried on the parent's financial as a $2 million asset, or $2,000 asset. Say in 60 days, about 3 months, you expect the year-end accounting statements are going to be published. And they're going to use the temporal method. Let's make that temporal. In which the gains and losses affect earnings. Okay, so in this case, we might look at a stress test. Say, what if we just say a plus or minus 10% change in the value of the peso? What would our gains or losses be? Well, if the initial exchange rate, the value of the peso, is 1/12, and that increases 10%, it'll go to 0.09. If I invert that to quote it back in peso per dollar, a 10% appreciation of the peso means that the exchange rate goes from 12 to about 11. If the exchange rate goes down, the peso goes down, that means the actual peso per dollar exchange rate goes to about 13. If I then revalue my accounts, 24,000 pesos at 12 times 1.1, which is the new exchange rate, you can see that the value of the accounts go to 2,200, which would be a gain of 200. Right? It was 2,000. It now went to 2,200 with an appreciation of the peso, and you gain 200. If the peso devalues, you can see you lose 200. The next topic, we'll talk about earnings at risk, a better way to estimate losses. How firms manage translation exposure? Two primary methods. One, if you designate the foreign currency as the functional currency, you effectively bypassed all translation gains or losses from the income statement and go directly to the balance sheet. So firms prefer to have the foreign currency as the functional. And the next thing is natural balance sheet netting. If you have a long position in the euro, say if you have a lot of accounts receivables, it would make sense to then bill European vendors in euros. If you have a choice between billing them in euros and dollars, you can just bill them in euros. That way you have accounts receivable and payables in euros, and you don't have translation gains or losses. Another little trick is to make sure if you're going to, say, acquire assets for a European subsidiary, borrow debt to finance them. That way you create natural monetary liabilities in the same currency. And here's an example of doing even something a little trickier. Zapata is worried about the value of the peso because of the initial positions. And remember, either using the temporal or current rate method, they were long the peso. Right? So they had a natural position of long the peso. It was either 24,000 using the temporal method or 135,000 using the current rate method. So one little trick is they could issue 5,000 peso bond, taking the proceeds of that, converting them to dollars, and just paying the parent a dividend. So all you're going to do is take the debt of the firm, increase it by 5,000, which will increase your monetary liabilities. The cash is all gone, it's paid to the parent, and your equity will go down. In that case, what you're going to do is you're going to decrease your exposure. However, if they issue debt, which is a monetary liability, and then just simply hold it as cash, they've then just increased also the monetary asset. In that case, the exposure is unchanged. So the learning objectives for this podcast were to look at the types of foreign exchange exposure. That would be translation, transaction exposure, and competitive exposure. Translation methods in FASB 52. So we talked about the current rate method, the current non-current method, the monetary non-monetary method, and the temporal method. And talked about how FASB 52 requires firms to choose a functional currency for each subsidiary. Based on that, the method is determined. And we talk about methods of managing exposure. So first you measure your exposure to a currency with, say, a stress test. And then you can choose to do some natural balance sheet hedging. For example, issuing liabilities in a currency in which you have a long position in. And we've calculated translation exposure based on the translation method. And we've calculated gains or losses on a currency. Gains or losses on the currency would just be the value of the position in foreign currency units times the new minus old exchange rate, where it's dollar per foreign, which will then give you a dollar gain or loss. Now be careful when you do these problems. If you are long, just say your net long position in the euro, you just enter it. If you're short, change the sign of the V and make it negative.